So today I want to go over the IRS Form 8606 for non-deductible IRAs. I want to go through under what circumstances would you need to include this with your return, and some common examples, and more importantly why it is so necessary to have this if you have any non-deductible IRA. So for this taxpayer, John Q. taxpayer, an individual, and he wants to make a contribution to a traditional IRA, right? So IRA's got basically two buckets. You have your Roth IRAs, where you contribute dollars to a Roth IRA, after tax dollars that is. The account grows tax-free, and when you, the taxpayer, start to draw money out of the Roth, none of it is taxable to you, right? So it's all tax-free. Traditional, on the other hand, money is put into the account, and depending upon your income level, whether you're covered under a retirement plan, you may or may not get a tax deduction for the amount of contributions you make to the traditional IRA, right? Once the money's in the account, it grows tax deferred, and then when you reach the age of retirement and you start drawing the money out, again, the withdrawals may or may not be taxable. So in this example, we're going to say John wants to make contributions to a traditional IRA, and we're going to show a scenario where he's going to put money in there, but it's not going to be entirely tax deductible. So John is, let's go to page 1 of his 1040, just so we get to lay the landscape here. So he's a single filer, he's employed, he's got an employer, makes $56,000 a year in wages, and he is covered by a retirement plan with his employer. And he's got some other investment income here, other income. He runs a side hustle, and so he's got some self-employment income there. And so his AGI is around $65,000. So why is that important? When you make contributions to a traditional IRA and you're covered by a retirement plan, your deduction for the traditional IRA contribution may be limited or eliminated completely, right? So, and so the ranges change every year. So I've got, let me go quickly to the IRS website. So this is the 2020 contributions. They're more or less the same for 2019, but just to illustrate the point here. So if you're covered by a retirement plan at work, you're supposed to use this table to determine whether you get a deduction for the traditional contribution that's being put into your traditional IRA. So if you make less than $65,000, you get a full deduction, right? So if his total AGI was, let's say, 40 grand, he's covered by a retirement plan, and he puts $6,000 into his traditional IRA, he gets a full deduction of $6,000 on his tax return. And so that deduction is reported on Schedule 1, right? Additional income and adjustments. So down here, adjustments to income, line 19, the IRA deduction. So if John's income was below that threshold, he can put a full $6,000 in and get a full $6,000 deduction. In this example, it's limited, and we'll show you why. So again, if we go back, his AGI is around 65K, and so as a single filer, he's within this range, right? It's more than 65, but less than 75. If it was more than 75, or 74,000 was the actual 2019 limit, there'd be no deduction at all. So he can still put money into the traditional IRA, right? There's no prohibition on him contributing the full $6,000. That doesn't matter. He puts the full $6,000 in. The question is, how much can he take a deduction for on his tax return? If he made more than 75K, he could put the $6 grand in. But if we go back to Schedule 1, he wouldn't be able to deduct any of the traditional IRA contribution. In this case, he's within that kind of middle ground, so he gets a partial deduction for it. So let's flip back and kind of go over why that's important. Okay, so just keep this number in mind. So he's getting a deduction of about $3,200, but again, he put in $6,000. So why is that important? It's important because if you contribute to the traditional IRA and you have any non-deductible contributions, that gives you basis in the IRA, right? And so when you have basis in the IRA, when you start to draw funds out when you reach retirement, you're not taxed again to the extent you have basis in the IRA. Okay, so let's say that he put the $6,000 in, and the very next year he reaches retirement age and he wants to start drawing it out. If he got a full deduction for it, he'd have a zero basis, right? So the full $6,000 he takes out is taxable because he got a full deduction for it on his tax return in a prior year. In this case, he wasn't able to deduct the whole thing, right? So he had this non-deductible contribution, the $2,740, which gives him basis in the IRA of $2,740. So if the next year he hit retirement age and he wanted to draw out the full $6,000, of the $6,000 that's coming out, he has basis of $2,740, so only the difference there. The excess over the basis is taxable, and the basis is just a return of principal. It's not taxable income. And so it's very important that these 8606 forms are filed, because you can imagine a scenario where someone is contributing to a traditional IRA for many, many years, let's say 15, 20, 25 years, and they have non-deductible portions that are rolling forward every single year. You want to make sure you're tracking that accumulated basis, because when you start to draw the money out in 30 years, when you hit the age of retirement, you're only going to want to pay tax on the portion that's in excess of your basis. And this is something that the broker is not going to track for you, right? So if you've got an IRA set up with Charles Schwab or TD Ameritrade, the broker just issues a 1099-R for the amount that's drawn out at retirement. But if you can think of the 1099-R in your head, there's that little checkbox there that says taxable amount not determined. That's what's happening, right? They're saying, okay, well, we know this is the total amount of distribution because that's the cash we paid you, but we have no idea what portion is going to be taxable to you. And the reason we don't know that is because we don't look at your tax returns like this. We don't have your 8606 forms, and we're not rolling forward your basis in the IRA for 10, 15, 20 plus years. That's your responsibility. So, John, this is year one for him. He's 30 years old. When he hits 59 and a half and starts drawing money out of the IRA, he's going to try to prorate a portion of the basis across the distribution amount, right? So if he draws out, let's say $50,000 when he hits 60, not the entire $50,000 is going to be included in income, right? There's going to be some sort of return of principal amount. And so that's why, this is so important that taxpayers properly complete the 8606 if they have any non-deductible portions, because they want to make sure that, look, you're not getting taxed on more income than you need to. Okay. Let's see what else is important. Oh, and so again, a lot of taxpayers ask me, well, what's the point of this? Why do I even bother if I'm not going to get a full deduction for the contribution? Why do I even bother with a traditional IRA? The reason it's still a good investment opportunity is because of the deferral, right? So let's say John makes $100,000 a year. So he's over that $74,000 threshold, puts $6,000 into his IRA, gets no deduction for it, then comes to me and says, well, what was the point of that? I didn't get any tax savings. You still kind of do, because you put $6,000 in that can be invested. The traditional IRA grows not tax-free, right? It doesn't grow tax-free, but the income that's being credited to it every year, if you're getting paid dividends, if stocks are appreciating and you're selling them for capital gains, you're not paying any tax on that in the year that those events are occurring. right? All of that is being deferred for 10, 20, 30 years. And then when you start to draw the money out 30 years from now, you're paying tax on it then. So traditional IRAs, still a very good retirement vehicle for taxpayers, even if you don't get the deduction in the current year, right? It's still a good way to set aside some money that's going to grow, again, tax deferred, right? It won't be tax free because eventually when you draw it out, you'll be paying tax on it, but it will be tax deferred. And so as far as computing the amount that's non-deductible versus the basis portion, there are IRA deduction worksheets similar to this one that are included in the form instructions. And then if you use a tax preparation software, they're going to have these worksheets and formulas in there for you already. Right, so you just have to be sure that, okay, you make it clear that you made a contribution to a traditional IRA, not a Roth IRA, and then also within the program, there should be a way to indicate whether or not you, the taxpayer, are covered by a retirement plan at work. That's very important, right? Because if you're not covered by a plan at work, there's no limitation. You can deduct the whole thing. But if you're an employee somewhere and you're covered under the employer's 401k plan, there's going to be limitations on a year-to-year basis, right? So you've got to be mindful of those rules and the limitations as they change, from year to year. So I think that covers it for all the topics I wanted to address. Thank you so much for listening. And if you have any questions, please feel free to leave a comment below on the video. I would also super appreciate it if you could like the video, subscribe to the channel. I look forward to seeing you guys again. Thanks so much.